Hi, how are you today? So today we are with Brian Shannon. He is a best-selling author of the new book, Maximizing Gains with Anchored VWAP, and he is one of the best traders of the that's in the industry right now. How are you doing today?
I'm doing well. Thanks for having me on, Hunter.
Great, great. First, while we do have you here, I kind of wanted to ask you a question about what kind of habits you had going through this whole last year with this bear market that we've had, because I'm sure you've been through multiple bear markets before, and then I wanted to get into a little deeper dive into the anchored VWAP and how to use it.
Yeah, sure. So obviously 2022 was a very difficult year for a lot of people. People were trained through the easy money policy of the Fed to just buy the dip. And what in a bull market that was working. And unfortunately, what it did was it taught people a lot of bad habits that they were buying things and just expecting them to go back up. And then when the time came that they didn't bounce, they're stuck. And then you get into this whole psychology of what do I do? Do I add more? I can't sell it now if it just gets to back to break even. I've been through those emotions before. I didn't, no one's born with the ability to not have that. You have to, learn it yourself. So as you mentioned, I've been trading full time since 1991, and this was not my first bear market, not my first bull market either. I've been through several of those. So, what really has helped me get through it last year, and even in this year, which is starting out to be a pretty frustrating year, is taking quick profits, not chasing things in either direction, and making sure that I don't fight the trend. As I always say, my number one tool for the trend for the intermediate term time frame is the 5-day moving average. If the stock or the market or whatever is below declining 5-day moving average, I simply do not buy it. I don't consider it a buy candidate. If it's below a declining 5-day moving average, if it's above a rising 5-day moving average, I don't care if we're below every other moving average. I'm not going to short it, not yet. So, and then the other thing would be that I take partial profits quickly. We've seen so many moves. They look like they're breaking out and running out of the gate and getting ready for a big run, but then and they have a good day and a half, and then they fail, give it all up, and then go on to be big losers. So I always sell into strength almost immediately, not immediately, but once I get up to this daily R2, let's say I get a 1% move, I always sell a third, raise my stops, and just playing a super strong defense, really.
That's definitely what we've noticed right now too, is the breakouts are weaker and they're not lasting very long. So you have to take profits quicker. But learning those habits in this market, I feel is a little gonna help out immensely once we do get a bigger bull market in the in play too.
Yeah, I think it's a great learning market because it's a frustrating market. And if you cannot get chopped up too badly and not lose your money, then you're going to be in a better position when it comes out because you're going to establish the good habits. It's better to learn in a difficult market environment than in a very easy market environment where a lot of new people were attracted to the money market, and rightfully so because money appeared to be very easy, at least for a while. So if you can, instead of learning with getting away with bad habits in a bull market, it's better establish good habits in a bad market. That'll help the longevity of your career, and that's what's kept me in this business as long as it has. Is I just, no matter what the environment, I just don't trust the market, generally speaking. So I play a real strong defense and looking to make sure that I don't give big pieces of my money back.
I started using the 5-day moving average myself by reading your books, and it's helped me just following that trend immensely just in my trading.
Yeah, it keeps you a lot out of a lot of trouble. That's where you're
That's for
tempted to
sure.
buy it. You think, hey, well, it's at this support level, but it's below the declining 5-day moving average, and guess what? That perceived support level just ends up failing, and you save money. It's nice to not buy and watch it continue to go lower and say, wow, I usually would have purchased in that area, but now I'm not buying there, and that that adds to your results, just not being engaged when you shouldn't be.
Definitely, definitely. So let's go into the anchored VWAP and the VWAP of how first off, what is the anchored volume weighted average price?
Sure. So you have your traditional VWAP, the volume weighted average price, which is the measurement, the average price of the stock weighted for volume for the period of 1 day. That's the traditional VWAP that was invented in 1988 as a benchmark for institutions to say whether they're getting a good execution or not. The anchored VWAP is simply the VWAP, same VWAP calculation, except the start point is anything other than the beginning of the day. It could be from an earnings report. So you say, where there was a big event in the market, an earnings report, or a significant high or significant low. I want to measure who has control with 100% certainty from that point. So I anchor to that low. I anchor to that gap from the earnings, and it tells us who has control, the buyers or sellers, from that point going forward. It's a cumulative measurement that tells you from that point, here's what we know is the average participant, long and short, is involved at X price. That fact is undeniable. It's a truth. It's a scientific measurement, if you will.
Okay, okay. So what made you say how did you get to go from a normal VWAP to, oh, I'm gonna anchor it here or I'm gonna anchor it here? How was your thought process throughout that?
Well, so I first ran into the VWAP in 2003, and on the software I was using, there was really nothing written about it that I could find at that point. Of course, search engines and that have gotten a lot better since then, and I found out later that the anchored VWAP was invented in 1993 by Paul Levine. So I kind of independently discovered, I guess, on my own, but what I noticed on the software I was using is that I could do a daily VWAP, but then if I stretch it out, change the time frame to 2 days, I would see the 2 day volume weighted average price. So when it's anything other than 1 day, it's an anchored VWAP. So it's basically the anchored VWAP for 2 days. And then I started experimenting with it, going, well, this company reported earnings 13 days ago. How does it respond to this VWAP anchored to that point? So I just put it to 13 days, and it would start to show me, and I'd just be fascinated with how support and resistance really gravitated around that key number from an event. And to this day still, it blows my mind how accurate those numbers can be. So in 2015, I had the company Realtic in their software build the first point and click anchoring, and they called it the anchored VWAP by Alpha Trends, which was great. But you can just point on any place on a chart that you want, and add as many of them as you want. From that point, it calculates it forward cumulatively.
Now it's just it's an indicator you can get on almost every platform, correct?
Yeah, except frustratingly for a lot of people, not on Thinkorswim. There's some add-ons there,
Oh,
but
really?
yeah, so they have standard VWAP, but there's some people have created some other scripts as an add-on. But those scripts you've got to say Tuesday, March 27th at 10:37 a.m. So you got to type all that in. It's not just a
That's a
nice
pain.
point and click. And but there are, I think it was I forgot who it was. I know it's available on TC 2000, TrendSpider, TradingView, stockcharts.com, and there's a number of other ones that have it as well, and more of them seem to be adding it. I think because I've kind of helped to popularize it, so it's great to see it becoming more available rather, because it is so valuable, and people are getting that and getting better results, and that's just great to see.
Do you think that with the more people seeing it and using it, that it's going to kind of lose its edge and stop working in a way, or will it always be how it is and always work?
I've thought a lot about that, and I've answered that question a few other times as well. And I kind of think that if you're familiar with the turtle traders, the turtle traders
Mhm.
were famous for Bill Dunn, funded these traders and gave them very specific rules of engagement to interact with the market. And they had to follow the rules. They did, and they became some of the most successful commodities traders there ever were. And then those rules were published publicly. And someone said, "Well, why would you publish these?" And the answer was, well, because most people can't follow rules. They're always going to try to override things and try to be more to try to think independently and be smarter than their own system. And it usually ends up backfiring. So I think that a lot of people will, one, they'll misuse it. They won't trust it. They will just not use it correctly. I mean, a lot of people use a lot of technical analysis wrong. I mean, I see things that so-called chart crimes every day on Twitter that that's not a bull flag, that's not a head and shoulders. It's, I don't know what you're looking at to come up with this label, but so people will misuse it. And the beauty of the anchored VWAP is it doesn't matter what time frame you use it. You could be the intraday scalper, using that low 30 minutes ago or that high 47 minutes ago. Or you can use it for swing trading, mainly like I do, or investing. So it's applicable on every time frame. So people are going to be gravitating towards different time frames, and no one's going to end up doing things the same anyway. So that's a long answer, but I think it's important to explain why I really don't think it will lose its efficacy.
That's a great answer. Feel free to go on rants and continue. Like, I definitely think that people do use it, will start using it wrong, and I found myself using it wrong at times as well. And so I kind of want to, if we're able to get a chart and go
Oh,
over in a little bit, over what the wrong way versus the right way to
sure.
use
You
it.
want me to share my screen?
That'd be great if yeah.
Sure. Let me do that. It says you've got to enable me to. It's disabled.
Let's see. Where is it? Okay, try that now.
Okay. Yeah, that looks like it works. So,
Great.
um, we can just even is that you've got the right screen there, I hope.
Yep, I can see your spy chart.
Yeah, okay. So I've got a daily time frame and I've got a 30-minute time frame on the right. And people ask things like well, where do I anchor from? As I said, key points like an important high. So, I had been referencing this one for most of the last 3 or 4 weeks because, that high, I didn't know it was going to be an important high until probably over here. Once it started breaking down, I anchored to that and it was declining, and then it found resistance, and that resistance flipped, it got back above it, and now the buyers are in control there. So, what is the right way to get involved in the market? A lot of people say they want to buy the breakout in the S&P 500. And that's going to require a move all the way up to 418. It pulled back to 380. That's a huge move. If you're waiting for it to break out, that's why your breakouts don't work, because you're chasing a market that just ran 35 point, close to 10%. Instead, what you want to do is say, where do the buyers regain control? The buyers regain control over here. So we look at that gap right there, and that was this day right here. Let me just erase all that. But that was this day. So the day that it gapped above the anchored VWAP from that high, that was the day. So you can say, well, it gapped above there, I'm going to buy it. Well, if you bought it there, let's just, isolate that a little bit. And this is that day. So let's just go like this. So you could have purchased it, let's say right there at, $400.04. Well, over here, it's at 398 and a half. You're down $1.50, saying, well, what's going on here? Is it going to, fill the gap, or you're going to get, chase it? So instead, what we want to do is we say, well, that was an important event. I don't want to chase that huge gap and just blindly buy. Instead, I want to let that settle down a little bit. Maybe you're going to scalp it to the short side. But as soon as it gets back above this volume weighted average price for that day, that tells me the buyers have regained control for the session. We had some initial profit taking. I want to be a buyer right here. But if it doesn't continue higher, I want to set my stop under this low. And you can see it took a little bit of time for it to really get going and find its legs, but it got going. It followed through the next day. And we could do the same exact thing the next day. Do you want to chase that gap, or do you want to wait for it to get back above the VWAP? And it's so the point is it can allow us to look at this market, and it would make more sense even if I ignore the 5-day moving average, because now that's not a 5-day. But here, this just allows us on a 15-minute time frame to see it with a little bit more detail, that when it gets above those anchored, those VWAPs from that peak, from that point. So let's just isolate that again and say, one, if you chased the gap, you would have been looking at going, what am I doing? Or even if you had shorted it, into this strength, maybe your stop was above this high of the day breakout. So even that day, people buying the breakout, well, what happened? They bought that breakout and then bam, it went right back down. Buy when the buyers have regained control, and then say, do they still have control? Let's set an anchor underneath there. So you can see how we found it, tested it, but it found buyers there again. And then the next day, it pulled back close to the prior day VWAP, and then got above the first day, that day's VWAP right in here. I probably wouldn't have purchased there. It would have been a little bit extended. But the point is, with today's market, this is what we have. Now, if we start to see this market pull back a little bit deeper, what I would be looking for, and you can see, let's just go back to that gap. So we know that that gap was an important event right here on that day, because it got above the anchor from this point where the sellers had control. After this big rally, the sellers took control. They regained control on that gap. So we set that anchor there, and look what happened this week. We came down and tested it, but couldn't really hold below it, and buyers maintain control. So if we see a deeper pullback, well, then the next level, let's say next week, we might end up seeing something like this. Let's just say this fails and does this and breaks down. Well, I would expect this level to be tested. So it kind of goes from level to level. And when it gets up in here, 3 to 4 days after that gap, and you're looking at, or, even if it was up, let's say this was the breakout right here, you got to look at it and say, is that really worth buying? Is that, or is it too far extended? And basically for me, I might buy that day, but I'm going to have a super tight stop and be out of it quickly. I'm not going to have my stop down here if I'm buying after it's had this big move. So again, I don't know if I answered your question directly of where is an improper place, but that gives you a little bit of insight.
So questions, did not the first low, but the second low, is that would that be in quote improper? So on the 28th to 29th,
Oh,
the very
28.
lower, yeah, like the lower day there,
Yeah.
would
Well,
that be more of an improper? Why would you, for the very low on the 24th versus that specific low, to look
so
for
I
the
would
next
say that
level?
you would want to maybe even set one. We know that this was clearly an important low, right?
Yep, the
And then
October.
we saw that level was tested.
Oh, that's
So
yep.
once it starts moving away from that level, then we can say, okay, now we want to set an anchor there, because that seems like it bounced from an important level. Now I want to measure from this point forward. And it shook out that day. That was pretty, painful, because it was lower highs and lower lows. And then, I got involved. I remember I got involved this day, and I got out later, and I was thinking, man, I'm going to regret this sell. And I didn't regret it when it gapped higher, but I was able to say, okay, regroup. Buyers are in control. Let's buy in here. Sell a little bit at the end of the day to reduce my risk. Gaps up, starts to fail, sell a little bit more to reduce my risk. Then as it starts rallying again, my final third, I put my stop under here. I got lucky, it gapped up the next day, and I admit I sold it within the first half hour. So my purchase from over here, I had sold some on, and in before the close, I sold some on this right here, and then some right here. And I left money on the table. And guess what I always do?
Always tends to happen as long as you can get the meat of the move, right?
Yep. In this case, I didn't get the meat of the move, but the thing is, people will look at it and go, don't you regret not getting out at the high? Well, I don't know what the high is. Nobody knows what the high is. We only know true support and resistance. We only know the high and the low after the fact. That's why we can only set our anchor to this candle here, maybe on this day, right? We don't know on that day because the prior day we would have said, oh, that's it, that's an important high, let's set an anchor there, and that didn't provide any value. It gives us a reference point to say when the sellers took control, are they defending that? And here they did defend it, here they did defend it, and then it touched it again. So what we have is more repeated tests of that resistance, and we have these higher lows giving us clues that maybe it's getting ready to continue back higher. And if you missed it, because it was ugly that afternoon, well, you have that next morning, there's your entry, your low risk entry, because it got back above the daily VWAP, and you have your stop underneath the low of the day. If you just bought the open, where do you set your stop? Underneath the prior days, under the close, under that low. To me, I don't mind missing these moves because it's more about I can buy more shares right here because my stop is this much of a unit. If I buy it with this much of a stock, well, I can buy maybe 20% of what I would normally be able to buy right up in here. So it's more about using those multiple timeframes together to get a more accurate entry so that I can, participate in more meaningful upside.
Okay. So when you find like a high, like the one that we had earlier this week, do you anchor it to that very high point there and then look for it to get back above like it just did?
I often do, but and it's not necessarily, so I didn't buy here today because,
Mm-hmm.
it's the end of the week and wasn't really, I just wasn't engaged at that point. I figured it had already run. Maybe it's going to slow down in here. Instead, I look at this and I say, okay, well, what's most likely to happen next? If we pull back on Monday, let's just put this, this is today's volume weighted average price. So if we pull back on Monday a little bit in the morning, let's say it gaps up, people get, chase it because they're excited over the weekend. They want to miss, you don't want to miss. They chase that, it pulls back and they spit it out. But then what happens is the volume weighted average price from that high, the volume weighted average price from today comes up into this area. So as it tests that level, well, it's also testing the 5-day moving average. I do not want to buy there. That's not the way I engage it. Instead, what I look at is I'll say, this is going to be Monday's volume weighted average price for the day. And as it does this, if it holds the 2-day, what would then become the 2-day VWAP, and then gets back above the daily volume weighted average price Monday, I want to be a buyer right here with my stop under the low of that morning, because now that's where we also have the anchored VWAP from the most recent high and the most recent meaningful low. So I don't want to blindly buy there because maybe it's just going to do this and continue to fail. And where do I set my stop? Unless you're just, saying, well, 10 cents away, 15 cents, some random number, and you're just going to get chopped up in there if it goes sideways for 30 minutes. Whereas I'm going to be excited if it goes sideways for 30 minutes because that daily VWAP of money is going to come bearing down on it. And that range tightens up. I want to buy as it breaks here. That's my breakout. My breakout isn't over here above this peak right here. My breakout is right here. And as it goes up to that level, I'm almost always going to sell some to the people who are chasing the breakout.
Okay. And then, so how are institutions using all these volume weighted average prices? How do they use the AVWAP compared to the
Yeah,
the
great
normal?
question. I wrote about that in the book, and here's an example, I think, of an institutional program. I don't know for a fact that this is, but we know that the market, the buyers regain control over here. So there's institutions that say, hey, I want to buy, for the next month, let's say. And as long as it's holding the VWAP where the buyers regain control, I want to be a buyer as it pulls back down to that quote unquote fair value level. So they're going to have their buy programs in there, and that's why it becomes supported. So as I wrote about in the book, GameStop, when they had those hearings, they pulled Ken Griffin in front of Congress, and Ken Griffin was, he runs Citadel, largest market making firm. They do 35% of all business in the stock market. Well, his hedge fund, and he went on to say in Congress that, most of the algorithms that they run are VWAP based. And he said, it's not like they're giant orders, they're small orders that add up to create the big orders. They do that to mask the size of their position. And so they don't have market impact costs. They don't want their buying of this market. They don't want to buy it on the offer and chase the market higher. They want to buy as it comes into these so-called fair value levels. Or if they're buying throughout the course of the day, they don't want to buy it all at once and drive the market higher. They want to do it without interrupting the market. So he said, basically we do 35% of the business in the market. Most of our business is done with algorithms based around VWAP. And he made $4.1 billion last year personally, the biggest amount of money that any hedge fund manager has ever made. When he says this is how institutions and how they run their orders, you better freaking pay attention. This is what's going on. So, and that's the thing, is that an institution has to buy, let's say, 10 million shares of a stock to have a meaningful position. Well, they'll look at it and they'll say, we want to, buy that over the next month, because if we go buy 10 million shares and the stock trades a million shares a day, well, the stock's going to gap way up and we're going to pay this ridiculous price, and then it's going to drift lower, and we kind of shot our load all at once. So they want to say, over the next 20 days, 22 days of trading in the month, let's just call it 20 days, we want to buy 500,000 shares each day, because 20 days, 500,000 shares, that fills our 10 million share order. Well, they're not going to go in on day one and buy that 500,000 shares right at the open, because again, they're going to gap the stock up $2 and then it's going to drift back down. So instead they say, we've got 500,000 shares to buy. In the first 10 minutes of the day, the stock typically does, or let's say first 15 minutes of this day, the stock trades 10% of its average daily volume. And I'm just making these numbers up to make them nice and equal. So what they'll do is they'll set their program to buy 10% of their order in that first 15-minute bucket of time. So they're going to buy 50,000 shares in those first 15 minutes, because that way they're only doing 10% of the volume in that period. And that's the 10% of the overall volume of the day, whatever. And it allows them to buy 50,000 shares, 500 shares at a time, 300 shares at a time. No one sees them just go in again and blast the order book with 50,000 shares, because everyone's going to see what they're doing. And they don't just go put in a bid for 50,000 shares. People are going to say, hey, there's a bid at $25 for 50,000 shares. I'm going to bid 25.01. Somebody else says, hey, that guy jumped in front. I don't mind paying 25.02. The offer at 25.03 says, wait a minute, there's competitive bidders in there. I'm going to raise my bid from 25.03. I'm going to raise it to 25.10. And then the 25 bid goes to 25.04 bid, and the 25.10 offer, 10 offer goes to 25.12. And you start to see, people picking off the offers because they see this little competition going on underneath the market. And you get these little mini front runs happening when, people are smart enough to see, hey, there's a competitive bidder in there trying to buy this stock. And what we're trying to do is to ride the coattails of what the institution is doing. And what they're trying to do is make sure we don't notice what they're doing, because they don't want to play with their cards up and let all these little traders get in front of them and front run their orders. So it's just a big chess game, and they're trying to minimize their impact and trying not to reveal their true intentions in the market.
They're actually buying on the VWAP or below VWAP. That way they get fair
Ideally
value.
they would like to, and that's something that you often see, is that we'll often see a stock in an uptrend gap down, let's say $1. Let's say you've got this $50 stock and it gaps down $1. Well, a lot of times what's going on in there is that institution who's tasked with buying 500,000 shares today, they'll go in and, the stock closed near the high the previous day. They know that there's going to be some people who are nervous about holding it overnight. And if in the pre-market, they can offer 20,000 shares and get that stock to gap down $1, and then people start selling their stock. Well, they've got these sneaky little bids for 300 shares, 500 shares. And let's say in the pre-market, they scare that stock down $1. Well, they're into the prior day's VWAP. They're going to try to buy as much in the pre-market as they can to get a head start on that order for the day, because they know that there's emotional people left over from the prior day. So they're going to be trying to, so they're going to sell 20, 25,000 shares to try to get it down $1. But once it's down $1, they're going to try to buy 100,000 shares. So they've covered their 25,000 shares short. And now there's long 75,000 shares of this 500,000 share order. People start getting wise and saying, hey, someone's scooping up all this stock down here. So they've kind of manipulated the stock lower so that they could get a bigger amount filled early on and get a head start on that order, because they know that their buying is going to influence the market. They know, let's say there's a healthy market and this stock reported earnings 3 days ago and there's other competitive buyers in there. So it's again, it's just all a big chess match. And the whole thing to realize when we look at anything on a chart, whether it's a cup and handle, a head and shoulders, is not just memorizing these patterns and these candlestick formations. I've never made a dime because I've recognized a candlestick, chart pattern. I've made money with heads and shoulders and that sort of thing. But what's more important is to understand the psychology of what causes those patterns to develop. So in every single chapter of my book, I've got, as you know, a chapter about, a section about psychology. What's going on to make this happen? And I want people to not memorize, okay, it pulls back to VWAP, I should look to be a buyer. Why? Why are there other buyers there? Because once you understand why, it gives you that extra confidence to say, I understand what's going on here. But if it breaks below that point where you started to buy and the most recent low, something changed. You don't want to be around to, sell first and ask questions later, as they say. The nature of the market changed somehow. It's not doing what I expected it to do. That's what our stop loss orders are, is to say, let's move on. Enough of this, done.
Okay. So when you're swing trading, you're using more of a 30-minute time frame?
I actually will look at more than 2 time frames. So this is just one that I've kind of gotten to use for doing my videos. I'll look at a weekly chart, a daily time frame, a 30-minute, a 15-minute. I'll even go down to a 5-minute, 2-minute time frame. I'm looking for that ultimate trend alignment where I can get the most accurate entry possible. If I can do that, then that gives me the advantage of other people. I want to be aware of where are we in the bigger picture on the weekly time frame. Are we transitioning possibly to a stage 2 uptrend? We're fighting with the anchored VWAP from the all-time high right now. Is this market going to be able to continue to move higher? Well, let's look at the daily time frame. It just rallied from 380 to 410. I'd like to see it pull back maybe towards the anchored VWAP from this low, which if I anchored it properly, would bring us down to about 400. Well, if it brings us down to 400, that's also our year-to-date anchored volume weighted average price. And that often acts as support. So if it pulled back down to there and started rallying from this point, I would then be looking at the shorter term time frame and saying, let's say that this was right here, I'd be looking for the same thing to occur. I wouldn't want to buy the pullback. I'd want to see it consolidate a day or two, start to turn higher, and then put on a swing trade, expecting it to do this. As it breaks this point, sell some to the breakout chasers. As it breaks out here, sell some more to the breakout chasers. Sell when you can, not when you have to. Sell into strength. Realize you're not going to get the high or the low with any type of consistency. So I use kind of all these different time frames together. And when I really get involved, I'll go down to a 30-minute isolated by itself, 15-minute, 10-minute, 5-minute, 2-minute. I'll even go down to a 1-minute time frame, and just, and that's for my swing trades. It just depends on what's going on. Here's, the S&P 500 today. It gapped down, got trapped below the VWAP. Here's a great little scalp trade. Buy here with a stop under there, sell some into strength, sell some on that breakout, raise your stop up underneath this low, out right here. It makes a lower high, it makes a lower low, chops around the VWAP, breaks back above it. I didn't buy there because I thought it was extended. I did buy right here after that little pullback, and my stop. So I bought here with a stop under there. And that was you could have, and what you want to do is, look objectively and say, where did the buyers take control even after this rally and that pullback? Well, if we anchor a VWAP to that little high, so again, we're talking for a scalper, it had this rally from 407 to 408 and a quarter. It began to pull back. It broke above the VWAP from that little peak. I want to buy here with my stop under there, sell some into this strength, sell some as it breaks down there. It tested that VWAP. Maybe you're going to be a buyer, add some back there, sell some over and over again. And it just, so again, going back to your question of will it stop working? Not everyone's going to take it to this level on a 1-minute chart where you're anchoring to these key levels on these 1-minute candles, right? So there's all kinds of ways. Really, the shorter time frame you go on, I've been doing this 32 years now, so I'm comfortable trading on a 1-minute chart if I don't see opportunities on larger time frames. But the shorter the time frame you go on, the more likely you are that you're going to screw things up, and you're going to misuse the VWAP, and you're going to make emotional decisions.
We've noticed that the smaller time frames, you can get mixed up a lot by either going like, instead of going to that first high on from today to to that second one, that could just mess you up a little bit just from those little differences.
Yeah, I mean, it gets to the point where, you start looking at all these time frames and you get distracted, and you get in the trade. And this is what happens with, in particular, less experienced traders, is they forget where we are in the bigger picture. So it's always important, I think even if you're a day trader, it's important to be aware of where we've come from in the last 4 weeks, that we've had this rally, and look at what happens after these rallies, right? When we see these types of rallies, buying after these or buying these breakouts, again, let's just go back, let's go over here to the weekly time frame on the SPY, isolate that. And what happens on breakouts? Well, this was a breakout right here on this day. It broke out, and then it broke that high right here. And are people making money on these breakouts is what you have to ask. Are they making money there? What about the NASDAQ? Are they making money on these breakouts consistently? Or, sometimes they are, but wouldn't you much rather look at it like this and say, we saw this rally, then it pulled back? Well, so we want to say, what's the average participant since then? The buyers regained control from that high right here. Absolute 100% fact. So if you can figure out on a shorter term time frame a low risk way to get involved there, and then sell some to the people who are buying the breakout, and then raise your stop up, and maybe you get stopped out at the same price a couple days later or whatever, but you're not acting emotionally and buying after a move from 257 to 300. That's just dumb buying up there, buying these breakouts. Or what about shorting breakdowns? Even, same thing. Was it was it smart to short this breakdown below the prior low? Part of that, for a couple days in that week, maybe it was it smart to short this breakdown? Was it smart to short this breakdown? You could argue that it was. What about this breakdown, right? You could argue that this one was a good one, but it had just dropped from 380 to here. Wouldn't you much rather be involved when the sellers took control at this point right here and cover some on the breakdown and lower your stop as it continues lower? And you can do this on any time frame. We're looking at a weekly chart just to make an example, but I could do the same thing, I'm sure, with a 30-minute time frame. Was it smart to buy this breakout here that morning? Was it smart to buy this breakout right here? You could argue maybe it was, but was there a lower risk way to purchase it by saying, I'm going to buy it as it breaks above the VWAP for the day and then set my stop underneath the morning low? Was it smart to buy this breakout? Or would you rather say, I'd rather buy it as the buyers regain control? And it wasn't a perfect entry, but I'd rather buy here with a stop under there than buy here with a stop under there. And then as it breaks down below that VWAP, it gets back to break even. I'm generally going to say, you know what? Look at where the market's come from the last month. I don't really want to be holding a lot of this. Maybe this is a scratch trade. Maybe it's a very small loss. Maybe I eke out a 3-penny gain. It's better than continuing to hold it through this period, making an emotional decision on a gap down in the morning and throwing your stock away.
Okay. On weekly charts, how far back do they go? How far back, like, can you anchor a view up? Is it still relative?
Well, yeah. I mean, so good question. I mean, I've been looking at the anchored VWAP from the COVID low for a while, and because that was an important low. Now, the anchored VWAP from this high, we were still battling that COVID VWAP right here. That was this point. From, I don't know why I put that one there, but from this peak, that has been important. Now that was close to 2 years ago, year and a half ago. So if it's still relevant, I want to know. And I'll look at this and say, well, this is clearly an important low. That was an important low. And, if we look at this one, we can see that the most recent pullback kind of found buyers right in there. So now, if I was an investor and let's say I got involved here, I would probably have my stop under there because it is this anchored VWAP from the October low. It is close to the year-to-date anchored VWAP. So it depends also on what your time frame is. But even as a shorter term trader, you want to know where those key battlegrounds are up near that anchored VWAP from the all-time high. That how did it get there? Where has it come from? It just rallied this much. What typically happens when it has these types of rallies? Does it continue to just ramp higher? Or do we get a little bit of a pause? What's normal in terms of market direction and sometimes misdirection where we get a little failed breakdown, a little bear trap that shakes people out that are early, and then the real move begins. So how long to keep them on is, we could put one on from here, but does it have any relevance to today? No, it doesn't. So if it's not relevant, why clutter up your charts with all these? I mean, you could put them on all these highs and all these lows and, say, well, look at this. What does that tell me? Maybe it tells me that from all these high points where people chased, there's a lot of price memory. And this seems like it could be a level that where supply is found. And maybe it is going to experience a pullback first, a false start, a shakeout, and then get going. Because that's how markets trade. They don't trade the way textbooks tell you they do, which is why I include a number of failed examples in my book. I said, and I was very clear, here's a non-textbook example to show you that even if the move fails, it's not the end of the world, because risk management, which is part of every single chapter as well, is what keeps you in this business.
What about IPOs? How far back and how long, like, for an IPO? Because I know you talk about that a little bit in your book.
I did,
How
and
far
so
back can
yeah,
do
and
you
so
go?
here's an example. I mean, this is the IPO, from Alibaba, and in
Oh,
Alibaba, when they came public, I put a VWAP on them, and I was trading this stock back then around this because, very similar to a gap up that we talked about on a 1-minute chart. Do we want to chase that gap? Well, the sellers took control for the first 6 weeks. They regained control with 100% certainty right there. And then they lost control. And as they lost control, it rallied up towards that VWAP. The sellers came in. They rallied up towards that level. Sellers came in. And then what we saw was a shift. We saw these lower highs and lower lows. Then we saw a higher low, a lower high, but then it broke the VWAP from the IPO. And if you missed that, it pulled back to that, tested it, found support, and then maybe you're going to buy there, or you're going to buy as it breaks back above the VWAP from that peak right here, sell a little bit to the breakout people, which is fine, whatever. Not looking to get out at the high, but and here we are today, 13 years later, I'm sorry, not 13, 9 years later, and I look at Alibaba and I say, that was an important high. So let's just get rid of everything except the anchored VWAP from the IPO and from this peak. Well, those two come together right now. So I know this, that if I'm looking at Alibaba and I see, we're starting to maybe, is this a shoulder? Is this a head? And this is a shoulder. This is an inverted head and shoulder bottom. It's supposed to be complete when it breaks above here. So if it breaks above there, I wouldn't buy it. I'd be looking instead to say, again, shorter term time frame. Where are we? Well, this was an important high over here, and we just broke above that on a gap a week and a half ago. I also want to know, where are we in compared to the anchored VWAP to this low? Well, those come together precisely at this point. So if you're an investor, I would say your stop goes under here if you're involved. Now, when we look at this, we want to look at it from that gap. So again, it's multiple time frames. We're doing it one time frame at a time. If you missed the opening that day, boom, right there, the buyers regain control on this 30-minute chart right there. Buy there with a stop below the low of the day. Now the buyer, sellers, we saw them retake control. The anchored VWAP from the peak was defended right here. And then the buyers just retook control yesterday, or I'm sorry, this was actually today. So to buy here with a stop underneath this higher low, that's our entry. Now, if it gets above here, sell a third to take some off. And then we go back to the bigger picture and say, well, where does it have the potential to go? Well, maybe it's going to start doing something like this on the daily time frame. And as a swing trader, I want to buy here and sell here. I want to buy here and sell here. As an investor, you want to buy in here and sell some on the breakout. And if it continues to rally, well, then what is your price target? Is that the height of the pattern, or do you look for it to do something along the lines of this on this weekly chart, something like this? It shakes people out on the breakout of that head and shoulders, then runs straight into the VWAP from the IPO and the all-time high, consolidates there a little bit, starts to pull back, and maybe it pulls back to the anchored VWAP from this low right in here. That VWAP is going to look like this. And it's just about understanding market structure and how they all flow together on multiple time frames so that we can see this bigger picture along with the daily picture and the shorter term time frames, and fine tune our entries based on this information. On this 15-minute chart, we're entering because the buyers regain control there. How's that fit in with this 30-minute picture? How's it fit in with the daily picture? We're holding the year-to-date anchored volume weighted average price. That adds significance to this level. The anchored VWAP from this low adds significance. From this gap adds significance to that level where our stop goes. And here's where we are in our bigger picture. So it's kind of just blending them all together, which is why, I use multiple timeframes and VWAPs, and that's what I do. That's what works for me.
A huge rinse and repeat, it seems like, too. It's just back
It's
from
market
one
structure.
high to the new.
It's
Yeah,
supply and demand, and how do
the
we
fractal,
objectively measure it? And then
the
control
fractal.
risk.
Yeah. Controlling risks is the biggest job, biggest part of our job, biggest priority of our job, in my opinion, too.
And
And
then and
this has
then
helped
and then knowing when the
immensely.
buyers are in control and looking objectively and saying, well, from that highest point of this most recent move over here on the daily time frame, if it gets back below there, that's also from the lowest point. I probably wouldn't want to own this stock anymore. That would tell me the sellers have regained control. So I can look at it and say these are objective levels. And this could be a 1 minute chart of the S&P. It could be a 1 minute chart of whatever you want to look at. The principle of fractals is that you learn technical analysis on one time frame. It's applicable to every other time frame out there.
That's why technical analysis is so incredible. It's such an art of how
I'm sorry,
you
your
can do it.
volume's a little bit light. I'm having a
Oh, I'm sorry. Can you hear me
yeah.
better?
There you go.
Okay, sorry. That's why technical analysis is such a beautiful art to me that it's amazing how there's so many different ways and so many different ways to find the same thing, where you can have your VWAP and then your moving average and then some of your other different techniques all see the one thing, and know more people and are drawn to that or looking at that same spot.
You just hit the nail on the head. So I'm going to give you props there, is that's exactly what it's about. It's about understanding, why are people buying at that point? Are they buying because, not in this case, but maybe it's a 20-day moving average happens to be there as well.
Mm.
Maybe they're buying because that is the year-to-date anchored volume weighted average price, and it's held, it's gone from support to resistance back to support. And since whatever this was an earnings report, the buyers have regained control from that peak. Whatever your reason is, if it lines up with a moving average, if it is simple moving average, if it lines up with a Fibonacci, if it lines up with even the full moon, if you trade moon cycles, whatever, the
Same people do
more,
that.
and they do, and I'm not making fun of it, but it's definitely, the fringe. Do we want to know what one or two people out of 100 are looking at, or do we want to know what 95 out of 100 people are looking at and how they might respond in that area? The moon cycle might help us. So maybe that's 2% of our decision-making process or weight of importance in that area. Doesn't matter how you get to the conclusion, but the more people that kind of come to that conclusion in the same general area, the more likely it is to hold as support or resistance. And then emerges a battleground where the buyers can regain control, and then you give the benefit of the doubt to the trend. The trend, once established, more likely to continue than reverse, and you hold on to it for dear life, and raise your stops under the higher lows and just let the market work for you.
How soon set your stops to break even? Is it almost right away as it starts working, or do you give it a specific percentage?
It's not a specific percentage. It's often, I will use pivot points. So looking at a 5-minute chart, for instance, I often will, if I have a good little profit, I will sell a third at daily R2. So let's say I bought right here as it got back above, it started to rally once again. Or actually, let's just say I bought, as the buyers regained control here this morning, and my stop was under here. It pulls back, it starts to move again. I raise my stop to that point. My original stop might have been under here. So even if it's not, if I bought right here with a stop under there, once we've made a little low and it starts to rally from there, I'll raise my stop up to that level. So if I bought it here, and then as it rallies up to daily R2, I almost always take a third off at that point. So that's, in this case, it often acts as resistance. So it didn't here, but that's 102.60, I'm sorry, 101.66. My other rule is, if it's at that daily R2, 101.66, let's just draw that on there, and it seems like it has a lot of momentum, what I'll do is I'll look at it and say, okay, it's at daily R2, it often fails there. So, but it has strong momentum. Now, as it hit that daily R2, I'm gonna put my stop underneath that prior 2-minute low. As a new 2-minute candle opens, I'm gonna raise my stop under here. As this 2-minute candle opens, my stop goes under there. As this 2-minute, and I raise them up under here. So then finally, I would get stopped out on this red candle and be able to, make another 40 cents on that. So I use that daily R2 as my point to say, okay, it's getting to a statistical place where oftentimes it fails. I'm not going to blindly sell there, but because it has strong momentum, I'm going to switch to this 2-minute rule because it has strong momentum and get out of my first third there. So when I set my, sell that first third at it was basically right here. Well, then I'll look and I'll say, well, where should I raise my stop up under? Let's go back to that 5-minute time frame. I would most likely keep it there because that's approximately break even. And then Monday morning, let's say it does this, pulls back to today's VWAP, and then goes like this. Monday's VWAP looks like this, and it gets going again. I would probably raise at least half of my stop under here. Most likely the whole thing would go under there. That would assure that my purchase at this point, I took a third off here to reduce my risk. And now that it's rallying once again, I'm going to raise my stop to here to make sure that I at least lock in this much gain. And then as it breaks out, I'm going to do the same thing. I'm either going to sell a third right away, or I'm going to look at those 2-minute candles, and because maybe it just goes like this on those 2-minute candles and really takes off, and I can get another $1, $1.50 and sell some there. And then in the next day or two, as it does this and it starts to rally again, I'll put my final third underneath that low, and maybe it comes down and takes me out. That's fine. I got out with this much, and this much right over here. So I like to do it in thirds. And that goes back to one of your original questions was, what has kept me strong in this market. It's by managing aggressively like that, not selling it all at once, giving part of it the opportunity to run. If instead I sold some here and it comes down to my stop right here, well, now I'm not going to lose any money at all because I sold a third up here and my cost was here and my stop is there. I lose 10 cents, 15 cents on 2/3, but I took $1.10 on 1/3. I'm still going to come out ahead. And if the stock goes on to fail, then that's the way it goes. That actually reminds me of a trade in MAXN. I got stopped out of my final third on this one yesterday. So let's look at the 15-minute time frame. So I got stopped out of my final third on this one yesterday as it hit this low right here. And it went on and rallied up later in the day, but I'm done with that stock. I got involved over here, and now it looks like it made this high, it made this high, it made this low, and then it made a lower low. So right now, short term, it's making lower highs and lower lows. I can always revisit this stock, maybe as it comes back to the anchored VWAP from that earnings report, the 20-day moving average, and this anchored VWAP from the recent low. So I'll be looking for it to kind of settle down in here, and either it fails and I'm out, or I can just put a VWAP off of that, re-enter as the buyers gain control here with my stop under there. And I've already taken some profit, but I can go back to the well.
Don't buy the dip, buy the strength after the dip, correct?
Exactly. Yes. Don't buy the dip, buy strength after the dip, because we don't know, so for instance, here, you could have looked at that same strategy and said, well, I'm going to buy this dip. Fine. You got lucky. I'd rather buy here. I'm going to get out there. And somebody say, hey, well, it's back at support. It's at the 50-day moving average. I'm going to buy the dip. Well, now what? Now what? Now what? Oh, it's at the 200-day moving average. I'll add to it. Great. Now you're at break even over here, and you're probably going to sell it because you're just so lucky, fortunate. You feel so fortunate you're not taking a loss on it. Then you're going to give that upside up, and then you say, well, I'm going to buy the dip to the 50 again. And you get a little gain. You go, oh, I'm going to add it to 50. And then bam, you get smashed. Oh, I'm going to buy it to 200. Well, how did that work for you? So it's, the time-based moving averages can give us an idea of the trend, but the anchored VWAP tells us exactly where buyers have regained control. And that's what I'm interested in. I'm interested in the precision of, the buyers. Are they going to congregate at the anchored VWAP from that earnings report and this low? We know in advance this is a key level. Some people want to buy at that level. I don't, because again, maybe it does this. Instead, I want to look for it to do this. I want to put an anchor on that peak and say, we've got these lower highs and lower lows. Maybe this VWAP comes down like this. The range tightens up a little bit. The 5-day moving average comes down and flattens out. So maybe it comes down, has a little shakeout, rebuilds, gets back above these levels. I want to be a buyer here with a stop under here. rather than just playing guessing games because I think it's a good company or I think it's a great stock, whatever, our personal bias might be, make it based on facts instead.
Do you look at fundamentals much at all, or do you just strictly trade
But
based off charts?
I kind of view fundamentals a little bit similar to technicals in the grand scheme. And by that, I mean, as you were just talking about, we want to know where the buyers might be, right? We want to know maybe they're going to be at that conjunction of volume weighted average price levels from the earnings report and from that low and maybe even from that high right in there. We know that's basically the average price since the earnings report, from the highest point and the lowest point. That's a level of interest. So I look at it and say, I want to get interested in this stock in that area. What got me interested in this stock in the first place was I saw the big gap up. And I said, well, what was that gap? Well, it was earnings. It was better than expected earnings. The revenues were up, the earnings were up, and that motivated fundamental participants to get involved. I know that growth players want to own stocks like this. They have a good chart, they're selling more stuff, they're making more money. So I know it has the interest of growth fund managers. A growth fund manager doesn't want to buy a stock that's failing and just gaps up because of some upgrade or whatever. So I know that there's likely to be a source of demand from the fundamental players. I'm not buying it because of the fundamentals. I'm buying it because I know the fundamentals are viewed as positive to other people, and they are likely to continue to buy this stock at these levels of so-called fair value. They don't want to chase up here. They want to buy it at the lower price down in this area. So if I see volume start to emerge and I see that that is the 20-day moving average, and maybe I can look at this most recent rally and say, from this low to that high, that's a 50% retracement of that move. And I can say, well, maybe there's Fibonacci buyers in there. Maybe there's 20-day moving average buyers in there. Maybe people shorted it up here and they're looking to cover it as it comes back to that VWAP. Maybe people shorted it up here and they're looking to cover it at the 20-day moving average. So we have all these different people coming to the same conclusion in the same area. And then you've got those fundamental players as well who are saying, this is a stock we want to own, so here's where we want to take that action.
It's insane how accurate it can be a lot of times too, where it bounces almost to a penny right at the anchored VWAP.
I've been saying it for years. It blows my mind every day.
Yeah.
But again, and some people will look at that and they'll say, hey, I'm buying it because it's a VWAP, and that's fine. A lot of
Yeah.
times it will work. And a lot of times you'll get in, ahead of someone like myself who's waiting and watching. I want to watch whether this is a 1 minute candle or it's a, daily like it is here. I want to see the evidence, but I also don't want to buy it if it just had a run from 21 and a half to 26 and a half. I don't want to buy as it gets above that VWAP. That's just stupid. I want to see a higher low. And then I want to see that range tighten. And then I want to buy over here, which is what I did. And I want to get out as it breaks down out of my last piece. And fundamental people are going to hold on blindly as it does this if it fails. I'm going to be out saying, hey, that was nice. I made a little bit of scratch on that, but you know what? It's done. I don't care. There's 5,000 other stocks. I'll find something. Maybe it's in NEWR. That's same thing. Earnings report, VWAP from the low. Take a look at the anchored VWAP from this big gap up here where it's starting to find support. We've got a 20-day moving average. We've got a 50-day moving average. I know this is an important level. So when we break it down to a shorter term time frame, it's a little squirrely. It just ran from 69 and a half to 73. So I want to see this thing calm down a little bit and then maybe buy it above this high with a stop under here. I don't want to buy it above this high right here. I want to see it go above there, shake people out. So it's all about, not chasing, a little bit of common sense in terms of supply and demand.
Good habits. Having those good habits
Yep.
consistently and staying disciplined with them. And I think a lot of it too seems to be not using it as a, oh, I must buy right here, but using it as a tool to, with other market structure and your other indicators with your moving averages and whatnot, to help you decide and make your decision as another confluence.
It's a level of interest. Yep, that's all it is. And it's saying, so I just got stopped out of the DOCS. This was one I was short because it was here. You can see same story. The November low, there's the VWAP, and it just got trapped below it recently. Well, it's got a declining red 20-day moving average, declining blue 50-day moving average, declining black 200-day moving average. So that got me interested. It had this big sell-off. So I measured a VWAP from here and just shorted it the other day over here as it was breaking back down below the 5-day moving average. Got lucky on that gap, covered a third there, covered another third today at this point, and then up in here. And, I was in at this point, and like I said, a third off here at a third off there, a third off here. If I was still holding, then what? Now I'm in a losing position. It's about combining those timeframes together. And if it, I was hoping that it would get stuck under here, I was looking to, cover some on a break below this level. Well, the market doesn't care what I think. I got to get my partial profit locked in. It breaks above this little high, lock in another third, breaks above that high. I don't want to let this turn into a loser. So I'm going to get out, and, it went higher instead. Maybe next week I revisit this stock if it does something like this, and perhaps I, short this breakdown here with a stop above this high or above this high, if that's how it goes.
It definitely looked like it was going to break, and then then it didn't. But
Yeah,
never
and that's the
letting a.
thing is we can convince ourselves, hey, it's below that VWAP. Wow, it's
Mhm.
gonna go lower. I nailed the entry. I'm a hero trader. And especially in this market, both directions, things just are not holding the way they're, quote unquote, supposed to. ASAN, I was hoping this one would do this, right? You can see I'd sketched that in
Mhm.
last night. It gapped lower. Sienna today, this was what I thought was going to be a great swing trade. It was holding above for the first time in a while the anchored VWAP from the high that it made in 2021. These 4 days it was holding above that level. So what I had actually just erased by accident was it looked like this. I wanted to see it do this, and then I was looking to buy above here with a stop under there. Well, it gapped lower. What do I do with this stock? I just take it off my list. It gapped down. I wasn't in it. I don't care. I want to wait for price strength to confirm and then set my stop. Once in a while, you're going to be in a stock that does this. So then you have to have a rule of engagement or disengagement for that as well. My rule is I look at a 5-minute chart, and let's make this 5 minutes. I look at a 5-minute chart, and my rule is I wait the first 5 minutes. Then if it takes out the 5-minute low, then I sell it. So I would have sold here had I been in it. It didn't work great, but you know what? You have to have a rule, because what if it just kept doing this? Then what? Then you get trapped into that. Well, I'm going to buy more. What's wrong with the market? This is a good company. Don't they know what the analyst said? And the earnings are going to be, and all that's, bullshit that you run through your mind. And the thing about rules is they're gonna go against what you think should happen once in a while. But that's trading. It's about minimizing your expectations of perfection, really.
That's how you end up like Kathy Woods and some of these hedge fund managers that are just down so bad over the last year, because they're just not, they don't have sell rules.
Yeah. And in some of those funds, they're required. You have to be 90% invested. 10% is all the cash you're allowed to have. And then it becomes the investor's responsibility to say, do I really want to be balls to the wall long in these highly, appreciated stocks? Or do I want to take some of the responsibility myself and know what you're invested in? So, unfortunately, in the case of ARK, for instance, a lot of people didn't know what they were getting involved in. They didn't know that this played out cyclically absolutely perfect. That
Mm.
beautiful stage two uptrend turns stage two, stage three, boom, stage four decline, stage one accumulation at best. It's not in an uptrend. It's up for the year a good percentage, but it's not in an uptrend yet. An uptrend would really be confirmed over here. And I wouldn't want to buy it just because it gets above there. Maybe I would buy it above here, look to sell some up there. That's 4.5 points. That's 10%. And then if I was an investor, breathe a little bit easier on that 2/3 position I still have. And maybe it can do the miraculous and go right back up like this, the way people are expecting it to. But I warn you, if you expect that, you're a little delusional.
I think it was Jim Ropel that said only 2% of previous leaders become the next market leaders.
That sounds about right. I've heard studies like that. Yeah.
Hmm.
And when you have a portfolio of, garbage like Zoom and Peloton and stuff that, sure, they get little bounces in these downtrends, but Peloton's not going to 100 again. Zoom's not
No,
going to 580,
600.
even though her price target's 1200. It's just insane.
That's insane. And these have been picture perfect, like you said, for the market structure models, just accumulation, stage two uptrend, distribution, stage four downtrend.
Yep,
And
exactly.
I followed them with I think it was a Cisco where you see online like the market psychology of um
Yeah, that's one I put together way back here.
you put that one together. It almost follows that in line like to a T
Yeah.
from that. Well, thank you so much for doing this for us. That was incredible.
Yeah, Hunter.
I'm gonna have give an open mic to see if anybody wants to have any questions as well. And that's all for that though. Great timing. And if anybody wants to have a question, just say something in chat and I will let you go open mic.
Meanwhile, I'm going to plug my book.
Great.
It came
Robbie,
out in
I'm gonna
January and available on Amazon, Apple Books. It's on Google Play Books. It's on Barnes and Noble. So a lot of places to purchase it. And that's where you're going to learn about all this stuff I'm talking about here.
I see one question on the chat and he's not in here. It says, does Brian use the AVWAP for entries and exits itself, or does he use it in conjunction with other indicators and price action, which we answered already, as we went over a little earlier, how it's a tool to be used together as with other indicators and price action.
Yeah, I mean, I use it in conjunction, as we said, with basically what you see on my charts. I mean, there's
Mm.
nothing hidden here. It's simple moving averages. Most of my charts don't have volume on them. Only a few time frames do I put it on. There's on the 15-minute. I've got it on the 5-minute and 2-minute chart, but some of the time frames I don't even bother to have volume on.
Okay, okay. Do you use have you used volume profile much?
I have, it's something I looked at in the past. If you Google my name and
Mm.
uh, with volume at price. I did a video
Yeah.
probably about 12 years ago on it, and I've kind of replaced it with the Anchored VWAP. I just find the Anchored
Okay.
VWAP much more intuitive.
And it's you don't have as much on your screen.
Yeah.
Okay. I watched some of those older videos from YouTube from like 10 years ago, and it's you literally trade the exact same almost with the 5-day moving average and some and the anchored VWAP as you do now. And it's just you're the same process over and over. Just the consistency is amazing.
When you find something that works, you got to stick with it. It'd be foolish to keep tinkering with something that works.
All right. If anybody has any questions, let me know in chat. If not, I'm gonna end the recording and we'll be finished. Thank you so much again for coming in. That was very, very resourceful.
Excellent. Well, thanks for having me, Hunter, and my pleasure. Get the book.
Have a Yep, they say they'll pay you picking a book. No questions. Thank you, Brian. Have a great rest of your day.
You too. Thank you.